Coming up next, our panel, Private and Public Value, the two faces of banking. Let's welcome the panelists to the stage. This panel will explore the public value of banking and supervision and whether there is a trade-off between shareholder value and wider public interest. The panel will be moderated by Naomi Lloyd, a TV journalist and former presenter for Euronews and the BBC. She has interviewed heads of state, finance ministers, and EU commissioners. Naomi will introduce the panel members, and there will be a Q&A session to address your questions.
Well, welcome to our next panel conversation. I love that voice of God intro as well, by the way. I think that's a great addition. So welcome. So our conversation now, as you just heard, is about private and public value, the two faces of banking. And joining me to unpack this are our two distinguished panelists. We have Jella Benner-Heinacher, who's Vice President of Better Finance, Richard Gnodde, who's Vice Chairman at Goldman Sachs. Welcome to you. We're delighted to have you here. Just before we dive in, we do want to hear your comments, your questions. So if you're watching online, feel free to throw those in as you go along. I'll take them at the end. And if you have a burning question or comment here, hold on to it. We'll do our best to give you some time at the end. So, okay, well, let's get started. Jella, so just to know a little bit more about both of you, you are the Vice President of Better Finance, which is an organization which advocates for fairer, more sustainable, and more transparent financial markets for individual investors. And you are also, let me get this right, formerly Deputy Chief Executive, now Senior Advisor of Germany's oldest and largest association for private investors, DSW. Richard. There's a long list, I'm going to keep it quite short, but essentially you are Vice Chairman of Goldman Sachs. You've previously served as the head of Goldman Sachs International for nearly 20 years. There's a lot longer list as well. And you've been with Goldman Sachs in various high-level positions in different continents for nearly 4 decades. Wow, we have a huge wealth of experience and knowledge between you. I'm looking forward to picking your brains on this. And so we get the perhaps more philosophical conversation in our panel discussion, which is quite nice, quite unusual perhaps. And I wondered if we could start by defining what we mean when we're talking about public value and public good. So we're all agreed on what we're talking about here. Okay, so I'm going to go first and then I'm going to ask you. So the term, I have learned, was originally coined by Harvard professor Mark H. Moore, who saw it as the equivalent of shareholder value in public management. He sees public value as the value that an organization or activity contributes to society and the common good. Nearly done. And he also describes it as a concept that directs your attention to conditions in the world that you'd be interested in improving other than your own material well-being. This is what he says. I wonder what you make of that. And I'd like to know, in your view, what do you see as the public value in banking and in banking supervision today? Jella, I'll let you go first.
Thank you very much, Naomi. Thank you for the very polite introduction. I just wanted to add that Better Finance stands for more than 4 million individual investors in Europe. I think it's important to mention that again. And also thank you to ECB for having me here. So it really sounds a little bit philosophical, to be honest. But what does public value mean for investors? Well, it's simple. It ensures that the financial system fundamentally serves citizens, the society, and the economy. And for the investors, it all begins with the financial safety. That's most important. Deposits must be secure, essential services like payments and credit must function reliably, very basic things, and very important, savings must not be eroded by opaque fees, inflation, or unfair practices. So from the investor's point of view, public value is inseparable from their financial interests. But maybe let me turn to supervision, because this is also very, very important with respect to public value. It ensures by enforcing procedures and upholding governance and conduct standards the public value. And I would like to give you 2 examples where this did not work.
Okay.
So we have the Wirecard case, which is the first case I would like to mention, and the Greensill case. You all remember Wirecard was a DAX 30 companies in the 2020, and it was a fraudulent DAX company which caused for the investors losses of more than 15 billion euros. This is only the shareholder side. And maybe you've read the news this morning, our highest court in Germany, the Bundesgerichtshof, he decided that shareholders of Wirecard, unfortunately, do not have the right to any compensation. So this is really the case where households, private investors are really hit by such collapse. I would also like to mention the other case, Greensill, because, why do I want to mention it? It's, for me, it's a typical shadow banking case, and I think we should talk about
We will do. I'll let you mention this quickly. We're definitely going to come back to that later in the conversation.
So I don't have to explain, I think, the Greensill case to you. I think it just shows that savers were sold products that they didn't really understand, that they didn't really know, and they didn't really understood the risks. And this is very important. So let us, Naomi, have a look at what were the lessons learned from these two cases, at least from the investor's point of view. Banking exists to serve society. Yeah. I think this is very important. And when governance, supervision, or transparency weaken, then there is only one who pays the bill, and that's the individual investor and not the banks. So,
thank you. Lots to unpack there.
And final remark, Naomi, I just wanted to come back, sorry.
You may.
To the very remarkable introduction by Claudia Buch this morning, because she said two sentences where I thought, okay, this is really great. She said, do not weaken the existing system. Do not weaken yes. the existing system.
I was also going to mention that.
And do not water down the standards. Yeah. And I would love to say, thank you very much for this statement, because I fully support it.
Fine. Well, lots of this we're going to come back to and unpack. So thank you for setting the scene there. Richard, the same question to you. Public value in banking supervision. How do you see that? What's that for you?
Maybe I'll just start. I mean, the discussion today has really been about traditional banks, deposit taking, lending. And just to give you the perspective, because a lot of my comments will reflect my own history, which is obviously 4 decades with Goldman Sachs, and we do take deposits and we do lend and we do lend to people buying homes and mortgages and those sorts of things. But we're also a big capital markets player, and that adds a slightly different dimension, and I'm sure that'll come through in some of my comments. So I just make that point. Of course, you're asking me after 4 decades in the industry whether it adds any value or not. It absolutely adds value. I'm convinced of that. And if I look at Goldman Sachs as an institution, we've been around for 156 years. You wouldn't be around for 156 years if what you didn't add value. So I think that's the overriding point. We're here to service the economy. We don't stand here as principals. We're here to service our clients. What is our purpose? In a way, we oxygenate the blood that's flowing through the economy. We help create jobs. We help facilitate growth. We help companies, our clients, individuals, our clients, governments, our clients, achieve their objectives. We don't determine what their objectives should be. They do. They've got their own governance structures. But often to achieve those objectives, they need finance. And they come to us as a bank, and maybe it's off our own balance sheet. We do lend money. Or from the markets, and we access the markets and we access that capital for them. Yeah. And so, that is what the industry broadly does. It's an essential part of driving economic growth. Economic growth has probably never been more necessary than it is now, and obviously that comes to some of the regulatory discussions that I'm sure we'll touch on. But it's an essential part of our economic model, and I can't think of a better way to do it. So I think there is absolutely public value there. I mean, I'll give you one sort of historic example. Because I was thinking back over the decades, when I was talking, Microsoft. So Microsoft went public at around the time that I started in the industry. They raised $61 million in their IPO. Their market capitalization at the time was just over $500 million. But they did that IPO so that they had access to finance, access to markets to help drive the growth. And you think what Microsoft has done in terms of driving efficiency, driving businesses. Today, this is a company, as we know, which has got a market value of more than $4 trillion. That's what the markets can help companies achieve.
Thank you, because I think there's lots we can talk about and lots we'll dive into, but I want us to keep to the lens of, we're talking about this, looking at this through the lens of how does this bring public value? How do we safeguard that when we move on? So there was so much there. I mean, bits I picked out so that we can keep the focus on this. You serve citizens and society. It's driving economic growth. It's creating jobs. Gosh, there's so much there. And you obviously both clearly believe in this. So we've established that. So I want to move on to looking at how we protect this public value and safeguard it. I think quickly it's good to establish perhaps when we're looking at public value versus shareholder value, let's talk about quickly the differences there are in the way they're regarded and the balance between them in the US and Europe. Richard, I'll come to you. You know both things worlds well. So talk to us about that.
We run a global organization. We obviously adapt to the local situation, but it's a global organization, so we think about this. We don't think about it much differently between the US, Europe, or frankly Asia. Yeah, I think these are large institutions now. They need to go to the markets for external capital. I'm talking about the banking sector. So you have to drive returns for your public shareholders, and so you need to earn more than your cost of capital. And let's call that circa 10%. So that, these banks need to drive returns on equity greater than 10%. And if they can drive those returns, they'll continue to attract capital and be able to put more into the broader economy. So it's essential that banks can secure returns. In terms of the public good, this is a highly competitive industry. There are many, many players around the world, and they're competing. And to the extent that you get to a period where there are excess returns, those typically get competed away. So I think we should absolutely bear that in mind. This is not a risk-free activity. At the end of one of the functions that we provide is we are helping allocate capital across the economy. And it's in a market-driven way. Not every decision will be the correct decision. You absolutely will make loans that you wish you hadn't made. But you'll hopefully make a lot more than you're very happy to have made. But this is not a risk-free enterprise. You'll buy equities that don't go up. They'll go down in value. Hopefully you buy a lot more that go up in value. But you're allocating capital into an uncertain future, an uncertain world. But you're doing the analysis, you have processes, you have systems, and you're diversified and you're managing risks appropriately, and so that's long-term sustainable. But we shouldn't sit here thinking that we can live in a world where bad loans are not made, bad investments are not made. That will happen. The future is uncertain.
Okay. Just seeing though if there are any key differences to bring out. I don't know if you want to add to that, Jella. You know Germany well compared to the rest of Europe.
Yes, I think it's a very important point. I don't know well enough the US situation, but when I look at Europe, I see cultural and structural differences. And if you look at the European banking sector, it is shaped by a mix of public, cooperative, and private ownership. So I would dare to say shareholder primacy is not the #1 priority with respect to European banks. If you look at the German 3-pillar system, you have the saving banks on the one side that emphasize regional development. You have the cooperative banks that prioritize member welfare, and you have the private banks. And here we have only 2 listed German companies, Deutsche Bank and Commerzbank. So here we have the shareholder primacy, but I think over 60% of the German banking assets are held by public or cooperative banks. So I think the structure is a little bit different from the US, I would say.
Okay, so we have decided between us that public value is so important, and how then do we best protect and safeguard it? So my question to you is, how do you see the rolling of banking supervision and regulation in keeping this balance between private value and public value? Jella, I'll come back to you, and then Richard.
Well, actually, I'm a very strong supporter of a well-balanced supervision, especially since our last banking and finance crisis in 2008.
Yes.
So I believe supervision is an essential tool for maintaining this balance between public and private value. Why is it important? Because it enforces prudence and risk management. It ensures governance quality. It prevents, hopefully, mis-selling and misconduct, and it safeguards stability and trust. Of course, banks naturally pursue profitability, but without a strong oversight, risk can be externalized then to the taxpayers, to the citizens, and to the retail investors, and that's what we do not want.
I want to just come back to this sort of shareholder primacy comment. You know, when I think about this, and I think about this for our own firm, I think about it for other firms in our industry, but frankly, for any business. If your starting point every day and your only focus every day is where the share price is, you're not going to have a successful business. You know, the question is the service you're providing one that's valued? To the first point, you know, the answer is yes. Do you have the right people? Do you have the right culture? Do you have the right systems? Are you competing in an effective way? Is it long-term sustainable? If you can build, I mean, I go back to my Microsoft example. If you over 4 decades can build a product globally that people want and need, price it appropriately, you can build a lot of shareholder value. But if that's where your starting point is, you probably won't get there. And I think you go back to the dot-com bubble of 25 years ago. We all sat around those tables, and people sort of started with the IPO prospectus and then tried to work back to a business model, hoping they could get something to the market very quickly. And it didn't work. It doesn't work. It never will work. So it's an outcome. It's not. You have to build a business and build a valuable business, and there's a lot that that obviously goes into that. So I really want to make that point. I think long-term sustainability is key, and for a financial institution, that's about having the right culture, the right people. It's about putting your clients absolutely first. That is your mission in life. You are here to service your client base, so you need to put them first. You've got to do it with integrity. And you've got to be in the risk management business. And that is about diversification of risks, avoid concentrated positions, don't have too much leverage, have sufficient capital. You look at the capital ratios today in Europe, sitting at around 14.9%. You look at the liquidity position, the LCR ratio, well over 100% for most banks, excess deposits, 1.8 trillion euros of deposits. So it's just in a much sounder place than it was in 2008.
Yeah,
but it's a holistic picture
that
you need to think about.
Yeah.
But it's long-term sustainability. On the previous panel, 100 years, 156, we want to be for another 156. That's.
I wanted to come on to that, of course, and sort of see what we've learned since then, what the state of things is. But I wanted to just sort of push again on the public value and the role of regulation in protecting that. Jella said, I'm going to simplify, but which we're doing more of these days. She's a fan, but are you?
Simplify,
what's the role
yes.
of it?
I think I also
regulation and supervision to protect the public value. How important is it?
We have no ambition to make the world a less safe place. I mean, and I think we saw that in 2008. You could be in a car that's been driven safely, but if the other people on the road weren't driving safely, you'd end up in a bad place. So system-wide safety and security and soundness is absolutely essential, and the supervisors and the regulators and the policymakers play a hugely important role in that. There was a comment on the previous panel about policy volatility. And I was just reflecting on it, and I thought, that's right, there is a lot of policy volatility. And of course, that panel was focused on climate. But maybe sometimes we think we can have policy on too broad a sort of canvas. I mean, obviously, having the right capital ratios is critical. Having the right liquidity ratios is critical. Some of the stress. But none of us can predict the future. And I'm thinking, climate, I come back to this being a public good. The climate issue, moving towards net zero, absolutely critical. We got a $750 billion commitment by 2030. We're 80% of the way through it now. So we'll obviously go right through it. But if we could find the nuclear fusion answer and fund that innovation and have that go from a $500 million company to a $4 trillion company over the next, we would have done a lot to help. But we can't predict the future. Will that happen? Will it not happen?
And this
So investing and supporting innovation comes back to the public good.
Yeah.
But I think, as an institution, and by the way, we may make that commitment to a firm like that, it may not work out. Is that a bad thing? You took a risk. Depends on the holistic size, nature, shape of your balance sheet, because you will take some of those risks, and that's appropriate. That's what we do.
You touched on slightly earlier about 2008, post then. I think I want us to look forward, but before we look forward, I want us to look back a little as well. I'm just a quick recap on what would you say the lessons we've learned since then, briefly, in terms of banking supervision and protecting the public good. I'm interested in that, and also you've been involved in banking before then, post then. What are you both seeing that's harder, easier since this regulatory push post 2008? Jella.
Well, I think I'm very happy, first of all, to hear that you don't want to change any rules. So this is
that's
good
not
news.
what I said. That's not what I said.
That was my interpretation. Maybe I wanted to hear this.
Carry on.
3 lessons, I think, which still stand out. The first one is crisis unfolds much faster than ever before. And we heard this also with several cases, like the Silicon Valley Bank collapsing. Everything goes much faster than in the past. And also confidence evaporates very, very quickly, which is difficult in an environment where you want to incentivize individual investors to go into these capital market investments. Well, secondly, consumer harm occurs whenever conduct supervision is weak. And that's why conduct supervision is so essential for the investors. Just wanted to remind you of the Italian bail-in, the mis-selling cases. We also saw here again, we had failures that damaged the trust of the investors. And third, and I think I repeat this again, governance must be robust. The Wirecard scandal is a little bit the case where it was the contrary. So I think the overarching lesson for us is public value must be actively safeguarded, and investor protection should be also treated as one of the high priorities on the list.
Yeah, Richard, what do you see as the lessons learned where we are now, the changes you've seen?
Well, maybe I'll make 2 points. You go back to the crisis, and I think we will spend a lot of time on that. So I'm not going to add anything new here, but obviously it was all about concentrated risk, excessive leverage, weakening underwriting standards, and frankly the connectivity across the system. And maybe that's relevant because we might get into a discussion between private credit and bank lending. The fact is these systems are always connected, and you make a mistake if you just focus on this, because if this goes wrong, it might impact something over here. So there is connectivity. So that's point one. But the second point I'd also make, and no one's going to want to hear this, but banks will go out of business. Across every sector of the economy, there will be players who will go out of business. And I think it would be a mistake to try and create a system with the purpose of making sure that a bank can never go out of business. It would create massive moral hazard. It would create huge complacency. And I think that would be the surest way to see standards drop. So I think the question is, how do we accept that a bank will go out of business in the future, but it won't require taxpayers to come in and bail them out? It won't have contagion right across the economy. And of course, with the Credit Suisse example recently, maybe the Silicon Valley Bank example, there are some examples. I mean, who would have thought that we'd be sitting here? Let's go back 15 years and say, one of the globally significant financial institutions is going to go out, and it won't bring the whole system down. You'd have said that's not possible. That's what happened. So the question is, how do we have a system where there is moral hazard, there is risk, people are responsible for their own destinies, people have to make their own decisions, there's good, but there are also processes where if someone's going to fall behind, they can be taken out of the system without bringing the system down. I think it's a really important point.
Okay, so we've had a little look back. Now, this has been talked about lots already today. Where we are now, we're in this new complex environment, this heightened geopolitical risk. We've heard lots about it this morning. We've had this regulatory push. Banks are safer. But there are these new financial risks, many. And I suppose my question is, how do we preserve this resilience that banks have built up when right now we're seeing what some might say, I'm sure you might not say this, but aggressive deregulation that's happening in the US under Trump. For example, the Basel III endgame proposal, which is likely to be watered down or scrapped, which Goldman Sachs, amongst others, has pushed for. So how do we, given that there are all these new financial risks, things are changing so rapidly, as we've been hearing today, how do we preserve resilience? How do we move forward? Richard.
Yeah, we want to continue to live in a sound, safe, secure world and operate in that world. That's absolutely a given. We're not asking for and have not been advocating for a weakening of standards. But I also think we should continually look at standards. Why are today's standards exactly the right standards? They may be too weak, by the way, they may be too strong. The world changes, there's new technology, so I think as with everything in life, you've got to keep re-underwriting, are we in the right place? So I think that's absolutely appropriate. The Basel III endgame, of course, was much more about something that was still in the future. It hadn't happened yet. It was much more about gold plating. On the previous panel, people were praising Mario Draghi. I'll praise Enria because he himself said that would have been raising the capital levels for US banks much higher than the Basel rules had said. So for our institution, it would have, we didn't see the final rules, but looking at it, that would have been a 20-25% increase in our capital. That just seemed excessive. And there's a consequence to that, of course, but that seemed excessive, particularly when you look back over the previous 10, 15 years. We've been through the Russian invasion, the energy crisis, we've been through COVID, we've been through the Euro crisis, we've been through annual CCAR stress tests, and at each point, the banks seem to have sufficient capital, so why suddenly move it up 25%? And there is a cost to that, because you can raise capital standards, you can raise liquidity standards, but at the end of the day, the cost of that, because that's the input cost. That's like raising the energy costs for a manufacturing company. In the end, those cost increases will get passed through to the end user. And that has consequences. Pensioners will be paying more to transact in the markets. Borrowers will be paying more to get a mortgage. People who want to borrow to pay for university fees and school fees will be paying more. So that's not a good. The question is, coming back to balance, and that word's been used a lot today, what is the right balance to ensure that we are appropriately safe and sound, that the weak players can still leave the stage, but without infecting the others, but we can, in the most efficient and the most cost-effective and the most suitable, because obviously the mis-selling, I'd be absolutely with you, there should not be mis-selling, get to the end consumer. That's what we're here for, to service the end consumer.
Did you want to add anything?
Yes, sure.
Please.
I think compared to 2008, I would say that European banks are much stronger today. than in these times. But the major risks, in my point of view, lie outside. It's more the shadow banking, which is a real problem. And I think this is something where we have to take care of. And when these activities occur outside of the frameworks and outside of all the supervision, then it doesn't really help that much, since again, retail investors are also involved in these, or at least products are sold to the individual investors. And we at Better Finance, we always said, well, if you have the same activities and the same risk, why don't you apply the same rules? Yeah. It's not understandable.
Sorry, I don't want to cut into you. I want to talk about this, so but please.
I don't want to take away.
No, it's just...
Because I think from the investor's point of view, it's just not, we cannot understand it. You know, why do we have different rules? And we fear a little bit that the next crisis will probably come out more of the shadow banking. Yeah,
so definitely I wanted to ask you that. I mean, we've seen, you know, the recent collapse of the US firms, First Brands and Tricolor. So it's kind of 2 points. I wanted to ask you, do you see these as one-offs? Or do we have the next banking crisis in front of us? How concerned should we be? And it certainly cast a spotlight on these non-banks that are involved in bank-like activities. So that's a question. And also then, should we, instead of a rollback of regulation, be strengthening it to include them? So,
well, I mean, I make two observations, I guess. You know, I mean, the first, if we're talking about hedge funds, private credit firms, asset managers, they are subject to a lot of supervision, not necessarily by the banking regulators, but there is a lot of supervision there. So we should come back to that, and we'll come back to that in the First Brands case. And so I think those are sort of well run, well governed, broadly well supervised. I think there are other activities that really used to be exclusively provided within the banking space, which are no longer provided only in that space, although obviously the banks continue to do it. But really it was, and I remember the discussion about this in 2009, 2010. You know, these risks will still be taken. Do you want them taken inside the regulated space, where you have great visibility? Or are you going to drive them out of the space, and so they happen, and hence the sort of shadow banking terminology? So a lot of these activities are happening because the capital requirements to do them inside the regulated perimeter is much higher. So people can come. So the example to use would be these non-bank liquidity providers who are very active making markets across, the equity markets, for example, very big in the US, but big in Europe too. Unregulated, different capital requirements,
so
different supervision, and I think that is worth looking at.
If we're going to make it a level playing field, then they should be included in the regulation?
Well, I think that it's worth looking at. I don't have the answer, but it does seem you've got an activity here where you need this capital, this liquidity, this set of rules, and over here you're in a very different place and you're doing the same. But I think you have to distinguish between these activities. You don't have to be in as I said, the hedge funds, the asset managers, I'm fine. So then let's come back to your Tricolor and your First Brands question.
Yes, thank you.
So, those were obviously two situations where the people who lent probably wish they hadn't lent. They've got to look at it themselves, and were the underwriting standards appropriate? Was there fraud? Was there something else? Did something just unforeseen happen? And it's probably a little bit of everything. But these things happening is not bad. A few speed bumps along the road gets everybody else to be a little bit more alert. Are my underwriting standards up to scratch? Am I thinking about this the right way? Am I being competed to a place where I'm taking more risk than I should take? So of course, you wish they never had to happen, but sometimes speed bumps prevent you having a bigger accident, further down the road. So these are both unfortunate and probably regrettable, but broadly there's a message there. Go and re-underwrite your underwriting standards. Think about the risks you're taking. And I'll leave it there.
Okay. I'm looking forward to taking audience questions and seeing your comments and questions on this. Did I give you a chance to answer as well? Yes, please.
Maybe just one point, which I would like to mention. I'm personally a fan of simplification, less bureaucracy, especially in Brussels. I agree on this. But when I look at banking, I'm not a supporter of deregulation, to be very honest, because that's something we learned from the past crisis. And you said, and I think this is very valid, I mean, we talked about AI this morning, about cyber risk, about shadow banking, and I think regulation develops. And we will, of course, will also have to develop rules for these new fields. So I think regulation will not stop, it will not necessarily increase, but we will have to expand it to these new fields.
Yeah. Thank you. That also brings me nicely on to my next question, which is looking ahead with these new challenges. AI, fascinating discussion on AI earlier. So financial innovations like stable coins, you know, so much of this coming at us. I suppose my question is to both of you, looking ahead the next 10 years, I mean, obviously things are happening so quickly, things are unpredictable, but what would you see as the biggest challenges ahead through the lens of how we protect the public interest in banking along the way? Richard.
Well, I absolutely support the comments made earlier that, you know, sitting here in Frankfurt, our priority should be banking union and savings and investment union, and whatever else needs to get done to achieve that. So I think that's absolutely, you know, first priority. And then second, you know, global competitiveness. You know, the world is moving forward. AI is going to unlock opportunities that we can't currently see, and I think we need to, I'm not going to rehearse the conversations that we had this morning. I'm not going to predict exactly how it's, we don't know, but it's obviously going to change. And to the extent that we can, you know, we all employ a lot of smart people, and to the extent we can have this technology help them do their jobs more effectively, more efficiently, provide better service to our client base, that's going to be a great new world. So we obviously have to embrace that and seize it. So I'd focus on those two. And then I think we have a set of rules right now, capital, liquidity, otherwise, which are fit for purpose. We should continue to revisit their appropriateness. There may become a time we're going to think they need to be higher or maybe lower, but you know that feels set, and just keep the system safe and long-term sustainable. So those would be three objectives.
Thank you. Jella.
Yeah, maybe just 2 points that you already mentioned, but I think they are very, very important. First point is, yeah, we have to complete the banking union. That's one of the reforms and the next steps that we need. We also have to introduce the European Deposit Insurance Scheme, EDIS. And it is not understandable for retail investors that you have uneven protection across the member states. So you need a single market with single rules and single protection. Secondly, that's the Capital Markets Union, or we're not talking about this anymore, we're talking about the Savings and Investment Union, which is the same thing. We expect that investors are needed because the finances of the EU will have to need a lot of billions of money, just, you know, to build up resilience, to build up defense, to introduce the capital market. And for this, you really need the right standards, you need the right incentives. If not, European citizens will not invest in the capital market. And we have to bring an end to, and this was mentioned this morning, to the fragmentation of the markets in Europe, which is still not a good idea. And therefore, I was grateful that Chancellor Merz at least mentioned that there could be a merger of some stock exchanges, some important in Europe, because that would bring us already a little bit forward to avoid the fragmentation.
Yeah. Thank you both. We have a few minutes. You've heard from our panelists. Do you agree with them? Do you disagree? Comments, questions? Yes, I can see your hand up there at the back.
Good afternoon, Stephen Wolf, ECB. So maybe we've heard a lot of talk about the value from the banking sector. Maybe to flip it on its head, the value from a supervisory perspective. So our failures are always very public, our countless successes are private. So how do we measure public value?
How do we measure public value in terms of the supervisory
world? Yeah.
Okay. Jella? Richard? Richard? Yeah.
How to measure?
Well, you chose the life that you're leading, so you're obviously a believer in that. And from our point...
The reason I asked the question is, how do we justify our existence to the political powers so we don't get shut down?
Oh, okay.
I don't think that's likely to happen. One of our most important partnerships that we have is our partnership and our interactions with the supervisory infrastructure, both here in Frankfurt, but frankly in New York and Washington and London and out in Asia. And I look at this as a partnership. I think our objectives are all absolutely the same thing. We've discussed the public good, the importance of finance, how that helps facilitate all the things that we discussed: job creation, growth, etc., innovation. In the previous panel, we talked about €1 trillion of finance annually being required for the investment in the transition. That's going to require this industry to really step up. This industry has to be long-term sustainable. Our partnership with you can hold a mirror to us. You see the entire picture, we see our own picture, so you can add significant value. And we really look at it as a partnership, and I think together, if we can work together and keep those communication lines open, you obviously executing on your responsibilities, us on ours, we get to a better place. But I think when you're in the protection business, there are other people in similar positions. That when I talk to people in the intelligence services, as they say, we only have to make one mistake and we're front page news. The 1,000 issues that we caught before they were executed on, no one ever knows about. So that's the life you chose, and thank you for doing it. It's a hugely important job, and we all benefit from it. So thank you.
I feel like I want to end there because that's just a nice way to end. But if anyone had a burning question, I don't see hands, so it's perfect. That's a really great way to end.